Nice, good, good. Well, guys, thank you for joining Financial Due Diligence, Quality of Earnings. Ask me anything. What is it? Let's go right through it. I'm going to give you a quick background about myself. Patrick McMillan. I'm a CFO, fractional CFO, transactional advisor with a firm called Amplēo. Quick background about our firm. We've been around since '96, based out of Salt Lake City, Utah. Fast forward to today, we have over 160 consultants across the nation, consultants that are fractional CFOs and controllers predominantly, but we also have CMOs as well as HR professionals. So a little bit about us. So what is EBITDA? That's the whole thing that everybody's always wondering about with fractional, not fractional, but with quality of earnings. And we're going to jump into these details a bit more, but I wanted to lead right into this because that's such a huge, huge point of, if I will, argument from a lot of people. EBITDA and cash flow, which one's right, which one's wrong. Well, I'm going to present to you that all of them are right. It's not just about earnings. It's not just about cash flow. It's not just about income statement or balance sheet. It's about everything. And that really is what financial due diligence is. It's assessing the accuracy, reliability, and sustainability of the financial data. It's looking at risk and opportunities. It's providing a clear picture of the health and performance of the company. It really helps us to make those decisions. There's so many components. We're going to dig into that quite a bit today. I will leave some room for Q&A towards the end, but also if you have some questions during this, if you don't mind, I'm going to do my best to kind of monitor the chat and stuff like that too. So it doesn't mean I'm going to be perfect at it, but I'm going to do my best for it. So feel free to throw some questions in there as well. So I want to make sure and emphasize that financial due diligence has a lot of components to it. It's not just income statement and balance sheet. It's not just earnings. It's not just cash flow. It's tax diligence. It's really looking into a lot of the financial components and portions of the company, everything that really has to do with the dollar figures attached to it. And so quality of earnings is one component of financial due diligence. So I want to really dive into that name there, quality of earnings. Earnings obviously being, how much the company is earning in net income, operating income, things like that. But quality is really what it's about. It's not just about, well, how much, it's how have they earned it. A lot of people will ask me, what's the difference between a quality of earnings and an audit? Well, an audit will tell you what a company is doing that's in compliance with GAAP. But a quality of earnings will explain the why. Why are they doing that? How are they doing it? And why are they doing it that way? Where does their revenues come from? Where are they spending that money? Who are they spending that to? How are they spending it? What does it look like? What's their customer concentration? How concentrated are the earnings focused on the top 5 or top 10 or top 20 customers? What about the cost of goods? How concentrated are they focused on one particular vendor and they're getting their cost of goods or cost of sales from? So it's really the why and the how. So that's the big difference, where an audit will just tell you what they're doing, but a quality of earnings will tell you all sorts of components about it. Typically takes about 4 to 8 weeks. Who pays for it? It really depends upon whether it's a buy side or a sell side. And you hear that quite a bit. Buy side means the quality of earnings was engaged by the firm that's buying the target entity. A sell side means the firm was engaged by the seller or the target, the one that's actually going out to run a book. They've hired someone like Troy and the business brokerage to be able to go out and actually sell the company and everything too. So what does a quality of earnings look like? And here in a little bit, we're going to actually dig into our sample quality of earnings and kind of show you some of the components itself. But there's some main sections there. There's the executive summary. I'm telling you the TLDR, the too long didn't read. Here's what the revenues were. Here's what the earnings were. Here's what they comprise. Here's how the trends were. here's kind of some key components, key findings, things, the good, the bad, the ugly, the positive, things like that. Then you dig into what a lot of people focus on, the actual quality of earnings itself and the EBITDA, the earnings before interest, taxes, depreciation, and amortization. And then after that, and this isn't the same for every single one. This is how we structure our quality of earnings, but a lot of them are pretty similar structures to this. Then you've got the financial statements, and we dig into some of the components of, hey, here's kind of some trends on those particular parts, the performance of those things, and then working capital. Y'all have may or may not have heard of what's called a net working capital peg. And what that is, net working capital is how much a company needs to leave in the bank in order to continue on a go-forward basis. That peg is that particular amount. And a quality of earnings, you really should be able to dig in and find out and discuss what that peg is based upon some metrics and things. We'll look at that a little bit as well. And then the appendices, which are kind of the raw data and some graphs and some other things as well. So a quality of earnings, what does it feel like? Well, there again, I want to focus on quality, okay? That could be low or a medium or a high quality. What is a low, what kind of denotes a low quality? If the target or the company that you're looking at buying, or if you are the company that's selling, then you are the target. Things like delaying costs. If you're not replacing your obsolete fixed assets until like later down the road, you're delaying costs. If you're neglecting repairs, if you're, hey, you know what, we've done super well with our R&D, we're going to cut that off just to cut our expenses for the last 6 months of the year to make our financials look good. That's low quality. Doesn't mean it's wrong, doesn't mean it's illegal, doesn't mean it's unethical. It just means it's low quality. Because if you're cutting off that R&D, I'll use that as an example, then how are you going to continue innovating and creating new products and new lines and things for future earnings down the road? So those are things that you really have got to consider. You hear a lot of things lately about recurring revenues, MRR or ARR, monthly recurring revenues or annual recurring revenues, things like that. Those are high quality. The more recurring revenues that you have, then the higher quality you're going to have, because those are things that someone puts on a subscription and they forget about it, they're going to keep paying it. Or if they continue using it. For example, we have a cat, so what are 2 subscriptions that we have? Litter and food for the cat. Their subscription. You know what? It's a great model to have. If there's a lot of variability, if your earnings or even your revenues are seasonal, things like that, that's not quite as high quality as some very consistent things. I mentioned vendor and customer concentration. If you have some highly concentrated, and maybe a question is, well, Patrick, what does highly concentrated mean? Typically, if 20% or more comes from one, then that's definitely highly concentrated. Sarah, you have a question. Do you also look into historical CapEx and annual CapEx reserve requirements post-closing? We do that we look at what those things were prior to closing. For our quality of earnings, if we have a scope that's defined for just a QofE, we don't look at pro forma stuff. We just look at historical and then therefore what that potentially could be. But looking at things for post-closing, you're looking at pro forma stuff, we can do that outside of scope for quality of earnings. Those are things that we're used to looking at. So great question there. Thank you. Let's see, excessive amounts of debt, excessive accruals, things like that. Those are also low quality. Let's see. Why is a quality of earnings done independently? Well, because during an M&A transaction, and I'm quoting Chris Riley here. I don't know if y'all follow him on LinkedIn. Good friend of mine. Highly, highly recommend following him. He talks a lot about financial modeling. Every once in a while, he'll throw up my quality of earnings up there too. But he said a while back, during an M&A transaction, the buyer and seller are inherently at odds. Buyer is always trying to get the best price they can, and seller's trying to get the highest price they can. Now, not always, but that's typically how it goes. So the seller wants the adjusted EBITDA as high as possible and a high valuation where the buyer wants it low. So therefore, an independent firm like Amplēo will come in and do a quality of earnings or some sort of financial due diligence. Sometimes it's not just a quality of earnings, and sometimes it's small enough where you don't need a quality of earnings, but just kind of a block of hours to kind of come in and dig and see what you're finding. So anyway, so our firm will come in and help the buyer and seller agree on a true normalized profitability. That way you kind of have that third party validation. So I'm going to, let's see, let me stop sharing my screen for a second. I'm going to pull up our actual quality of earnings here in a sec. And just reading through the chat, I find that the interpretation of the numbers is crucial. Does Amplēo provide that based on their expertise from having done so many QofE reports? Yes, absolutely. There are so many times where, especially for search funders, we will jump in and really help you to understand what that interpretation is, what it means, because we have not just quality of earnings. So let me kind of back up really quick about our firm, and I'll talk more about this in the end. We don't just do quality of earnings. We have 160 consultants and about a dozen of us around the transaction advisory team. So the rest of our consultants are actual fractional CFOs, where we do a lot of financial planning and analysis, financial modeling, raising capital, helping a lot of growth companies and everything too. So we've got decades of experience where we can come in and really help you to understand the interpretation of those financials. I heard a professor say years ago that a CFO can not only give you the numbers, but can explain it to you in the terms that you can understand. That's what a real CFO needs to do. It's all about the storytelling. Let's see. Let me pull up. Here we go. Share my screen back again. Okay, hold on a second. There we go. Can y'all see my screen okay? Someone give me a yes if you don't mind.
Yes.
Nice. Good. Okay, thank you. All right. So this is our actual, I know some of y'all may or may not have downloaded this prior to the call. It's definitely on the link. So please be sure you download a copy of this. It's on our website. I'm going to back up real quick. This is a fake company. It's not just a redacted report. It's an entirely fake company that I created for the specific reason of making a fake quality of earnings. And that's why you'll see a lot of the revenues and things are just kind of straight lined across. Nevertheless, this is what a QofE looks like. So it kind of starts out with this financial due diligence report. There's just kind of some boilerplate stuff there. So this right here, table of contents, there's those components that we're talking about right here. We're going to look today a little bit into the EBITDA, kind of the statements and performance, and then later the working capital. So right here, kind of the key findings, the executive summary. There again, it's just talks about the scope, talks about the background. You'll kind of see this right here that just stays as we're flipping through here. Some more key findings. Here's the gross margin, kind of some of the major, spend. What the growth looked like. Just kind of some there again, some really key things that we're finding, as well as some other items that are, hey, we're going to talk a bit more about this. Refer to this other section. So the main part right here, the quality of earnings itself, this is where you'll see, this is kind of a summary of the financials. And you'll see there are 3 sections. Now, there again, I don't want to say every single QofE looks like this. Some do, some don't. They're all built differently. Every firm does it differently. This is how we've built ours. This is how Amplēo, our firm, does ours. I want to focus on these 3 sections. There's EBITDA as defined. That is the true, pure definition of earnings before interest, taxes, depreciation, and amortization. You'll see it's very simple. Get net income, you add back the interest, you add back taxes, depreciation, and amortization if there is any, and there you get your EBITDA as defined. Very simple. That, you can't really argue with that. That's just what it is. As long as the financials are reported accurately, That's what EBITDA is. Now, the next section below that, you'll see what's called management adjusted EBITDA. So a lot of times, and let's say this is a buy side quality of earnings. I'm representing the buyers. And so the sellers or the target company has said, hey, you know what? We are proposing that donations are going to be added back. Here's why. There's an accountant that we use mostly for the business, but you know what? Sometimes he's doing some personal stuff for us. So we said, hey, you know what? 12,000 a year is that personal portion. So we're going to add that back. Owner compensation, we're doing some adjustments for that because the buyers and the sellers have negotiated a specific salary, $300,000 for an exec to come in and take over, and so that's kind of that difference there. And then there's some travel expenses that were just personal, but they expensed on the business. It's a tax thing. A lot of times companies will they use their company as a lifestyle. They'll put in a lot of they'll hire Aunt Jenny, or they'll expense their truck or their travel because it lowers their tax. That's not wrong. I'm not a tax guy. I'm not going to tell you can or cannot do that. I'm just telling you what the firm is going to look like on a go forward basis after it's being purchased. That way we're able to show what it looks like if that owner were not doing that kind of stuff. A question, do you only look at 3 years? If seller provides, say, 5 years or more, that can be included in your analysis. Great question. Thank you. It is typical that what we do is we look at 2 historical complete fiscal years as well as TTM. And you'll hear TTM or LTM. You'll see that right here. You'll see those used interchangeably. TTM is trailing 12 month, or LTM is last 12 month. They both mean the same thing. It's the most previous 12 months that were closed. So back to your question, do we look at 3 years? It's typically for a quality of earnings engagement that we do, yes. We'll look at 2 full years plus TTM. So for example, right now, and actually this is fine, I just did this last year, we're looking at January 24 now. And so we typically look at 3 full periods. Sometimes we'll expand the scope to include another period. If you would like for us to look at 5 years, absolutely. We can adjust the scope and include that. So we will look at whatever it is that you need or would like, whether it's a buyer or a seller. I've actually been on engagements where we looked at 5 years and we did analysis, like deep analysis over the previous 3, but just showed the 2 years prior to that just for trend optics, just to be able to show what that looks like. So definitely we can and have done that as well. So great question. Thank you for asking that. Okay, so we talked about management adjustment. Now down here, we'll talk about diligence adjusted. So just to recap real quick, EBITDA as defined, can't argue with that. Management adjusted, it's what management or the target proposes what earnings should be. And then diligence, this is where we go ahead and then we will say, hey, you know what? This is what we have found. Sometimes it'll show some of the management stuff that we've agreed or disagreed with, and these are some additional things. Did someone have a question? I thought I heard someone asking something. Okay, moving on. Let's see, Nora. So from what I understand, the adjustments are made to refine the EBITDA and reflect the right nature of its operations. You've nailed it, Nora. You've also heard it. There are many ways to describe it. You can call it normalized earnings. That's the thing that we're trying to do. We're trying to make it seem what a normal business operations of this business particularly would look like. So yes, reflect the right nature of its operations. Great way to put it. Thank you. So there again, and over the next page, you'll see we like putting these lines around here just to show you what we're looking at. So over here on our quality of earnings, you'll see a lot of what the explanations are regarding why we felt that that was an appropriate adjustment, or if we've disagreed with something from management, we'll add it back down here and say, hey, you know what? For example, personal accountant. I'm just going to use that. It's not down here, but let's say there's a personal accountant that management proposes, and we, after our diligence, say, you know what? That accountant was absolutely not used for personal. It was 100% used for business, and therefore we're going to disagree with it. You'll see a negative number down here where it basically adds that back into the earnings, offsets it. Jacob, so if this is a buy-side QofE, meaning the potential acquirer hired a QofE firm, how do they figure out the management adjusted add backs? Is the QofE firm talking with the management team? 100% yes, we are. We are asking them, hey, because they are going to, regardless of how much diligence I put in, whether I put in 10 hours, 100 hours, or 1,000 hours, they, management, the target company and their CEO and CFO or accountants and everything, they're going to always know more about their business than I am. So I will ask them, hey, send me the raw financials or let me pull or extract the raw financials. And I want you to tell me initially what you feel like should be at a back, because that accomplishes two things. Number one, it tells me what you're thinking. It tells me how you're running your business. It's telling me what you're doing with the financials, what you're doing as far as a business standpoint. It tells me so much about you and what you're thinking. It helps me to understand what to dig into or how to dig into it. But also, and that's that second thing, is it tells me what you're thinking about what your earnings should be. I've seen so many deals where, and I'm just going to use easy numbers, where management thinks that their earnings are $1 million and their reported, we'll just go to these numbers, their EBITDA is 800,000, but management adjusted, they think it should be 1 million. But because they're, for whatever reason, this stuff is way not accurate, they're either closer to their 800,000 or even sometimes it's more like 600,000, because there's a lot of things in there that they haven't thought about or that a buyer is going to do that's differently than what a seller has done. Now, that's not the case all the time, but it is often, where they're very different. So asking those management adjusted EBITDA really helps not just me, but a buyer to understand, hey, you know what, here's how much negotiation we're going to need to have in order to get this deal across the finish line. So great question there. Thank you for asking that. Appreciate it, Jacob. All right, here we go. This is basically the same thing that you saw in this section right here on the diligence adjusted EBITDA, just kind of a quick graph summary of it. So now we're going to dig into, there again, let me make sure, how often, a couple of questions. How often do you see a deal fall apart due to a gap in valuation based on the QofE where a new price can't be agreed with at the seller? I don't know if I can put a percentage on it. If I had to, I would probably say maybe about 20% of the time. It really just depends upon, that's where pre-LOI, prior to sending and signing that LOI, you've really got to dig in as much as you can to see. That way you guys are doing the napkin numbers and really trying to agree on that, because if you're doing that and you're a bit more aligned, then that really helps the deal complete, go across the finish line. Let's see. Do you do any investigative diligence to verify the numbers provided by the management? Yes, absolutely. What we do is to validate. We will ask for invoices. We'll ask for reports. We'll ask for vendor invoices. Sometimes we'll interview and chat with members of their team, things like that. There's also, I'm going to jump to this real fast. There is what's called a proof of cash. So right there, we're looking at bank statements to make sure that what actual revenues are in with the bank statement. If you back out things like non-revenue deposits, we'll also do that for things like cost of goods. I don't think I have that one in this report. We will look at invoices, reports, things from vendors, so all kinds of stuff like that. So yes, a lot of diligence. What we try to do is testing. It's called testing. It's just like an audit. We go in and you test, like a certain percentage of certain things. So let's see. Back to, I hope I'm pronouncing your name right, Yaswant. Thanks, Patrick. Then I assume in the LOI, rather than a price, the buyer should be listing a multiple they will be paid based on the final adjusted. Now, I have seen them both ways. I've seen them just list a price itself, and I've seen them list a multiple, like a 2x or a 4.5x EBITDA, things like that. My recommendation is that multiple. And the reason why is because it's a whole lot easier to say, hey, you know what? Third party firm came in, found EBITDA to be this. We're still sticking with our 4x EBITDA, then that's a whole lot easier to negotiate rather than, hey, you know what? I know you said you wanted 1 million, but I see this as 600,000. That's just, it's going to end up at the same number. But if you do it based on that multiple, it's easier to digest. Jacob, so all this is done post LOI. I would assume that a seller is having to do a QofE with multiple potential buyers, meaning the seller has granted exclusivity to the buyer. Yes. Typically, and I'm going to answer that question first before we get into your next one. So typically what happens is pre-LOI, there's no exclusivity. You guys are chatting, there could be multiple potential buyers. Once you sign that LOI, then there's that exclusivity period. Sometimes it's typically between 45 and 90 days. And that's when you really are digging into equality of earnings and things like that. Also, is there generally a roll forward in the QofE as the deal progresses? Yes, we've done many of those. So that is very, very typical. I understand that businesses are valuing a business on some sort of LTM EBITDA figure. For example, let's say this business is doing a QofE as of LTM June 23. Is the buyer valuing the business off LTM June 23, or is it a 2024 LTM figure? What happens if it's August or September and the LTM EBITDA is very different? So that's why back to your first part, that multiple is so much better, because typically what happens, let's say you have a 90-day exclusivity and you're going to close in 90 days. We've done, this is January, so let's say we've done a TTM or LTM through December, and you're not going to close a deal until March. Then you'll say, oh my gosh, Patrick, they're giving me flash reports, and the TTM December numbers and the flash reports of TTM February, not quite meshing with me. Can you do a roll forward? Yes, we will. And that way you can take that roll forward, that diligence, all of that testing and everything too, and validating to make sure that your most recent TTM February is what you're going to actually pay for that firm. Make sure you have those kinds of things spelled out in your LOI. That's where it's very important that you have your deal team that is solid, your financial people like us, your business broker or iBanker if you're using one. It's okay if you're not. Troy, don't kill me for saying that, but I do highly recommend it. And especially making sure you have a good attorney. Let me specifically say an M&A transactional attorney. If you don't have one, let me know. I can refer you to a few people that I've worked with and really, really know they're worth their weight in gold. So that's where they're going to make sure that your LOI and your purchase agreement are all spelled out, for those things. So those are great, great questions. Keep them coming. Thank you, guys. Appreciate it. Let's see. Is the agreed price or multiple typically based on TTM? Yes, typically it is. Or an average of, say, last 3 years, especially if there's a large variation year over year. So what'll happen is your actual price is typically based on a multiple of that TTM. The last 3 years, that trend will really depend upon where that multiple falls. Let's say, for example, and I'm just going to keep using a 2 to 4 as an example because it's pretty typical. Sometimes you'll see up to 10. It all depends upon location, industry, things like that. So for ease of discussion, let's say 2 to 4 multiple. If they're a very, very high trajectory, high growth company, you're going to be on that higher end. You're going to be closer to that 4. If they're in a downward slope and they're lower, yeah, you're going to pay less. You're going to be more on that lower end of that multiple. So that's where the price is based on the TTM or LTM. However, that trend is really going to determine whether you're paying a higher or a lower multiple. All right, great questions. Let's jump for a few minutes and keep the questions coming. I'm just going to go ahead and spend a few minutes on some of these other sections, and then we'll hit back onto the questions. So please keep them coming over into the chat. So this right here, income statement summary, this is where we will adjust or restate income statement. And what I mean by that is a lot of times you'll see I won't say most, I'll say a lot of firms will put in a lot of expenses down here when really some of those should be up here. And if that's the case, it's not going to change your net income. It's just going to reallocate them, to different buckets. That's what we mean when we say adjusted or restated earnings or income statement. So right here is where you'll see a lot of times we'll go through and we'll look at a lot of trend analysis. Hey, here's the drivers behind that. Here's why the firm decided to do this. Here's what they did. Here's what vendors did, things like that. And then a lot of times people forget about the balance sheet. I cannot emphasize enough the importance of a balance sheet. Please, please, please make sure whomever you use, whether it's me, someone else, and I'm not saying you need to use me. I love providing information, but whomever you use, please look at the balance sheet. It is so important because the income statement only shows a certain piece of information of what's going on with that firm. The balance sheet shows a whole lot more, and that trend will really tell you a lot of info. For example, how's their cash? How's their AR? We're going to go into the net working capital here in a second to look at some specific metrics. But how are things going? What are the liabilities on the balance sheet? Usually when you buy a company, you're buying it cash-free, debt-free. Another conversation for another time. But just know that typically what happens is the seller will strip out all the cash and make sure that all the liabilities are paid. Now, when I say liabilities, I mean debt, all the debt. Make sure that debt is defined by interest-bearing debt. So there again, another time that we can dig into that a little bit more. So the balance sheet, yes, some very, very important things. A lot of times, especially lately, we'll still see some PPP loans or SBA loans, things like that. We'll talk about that, on the balance sheet. So here we go, the performance. This is where you look at a lot of the metrics right here. So sales by channel, that's the concentration, that we talked about. There's sales by product. There's, there again, some specific concentrations. A lot of times you'll see something called a hero product where, there's the one product that's really earning a huge, huge portion of the revenues. Now, not saying that's good or bad. I'm just saying be aware of that. You see that quite a bit in e-commerce. You saw that a whole lot during COVID, with the elderberry and things like that. And so just again, we like to point that out to make sure that you as a buyer or even as a seller are aware, hey, here's what your financials are going to look like, during a transaction. A lot of times, if we see something blaring, then we will put some specific language in here and say, hey, this potentially could be a risk. All the revenues are based on one product, things like that. So just be aware of those kinds of things. Margins by month. This is where we're talking about, during the TTM period, we're talking about, how those margins are based on specific cost of goods. We'll kind of dig into that a bit more. There's some, I'm a big fan of graphs. A picture can tell 1,000 words. It really helps you to understand, visualize what's going on. Proof of cash, we talked about that. Vendor concentration, we discussed that a little bit. This is where, you'll see where a lot of those vendor, where the cost of goods and things are coming from. Working capital, I want to spend a few minutes on this. This is such an important thing to look at, net working capital, because there again, you're buying the company on cash-free, debt-free. You want to make sure that whatever, after they strip out the cash that they've earned, that there's going to be put back in however much cash is needed to continue operating the business. What you don't want to happen is to buy a business for $1 million or $10 million, then have to turn around and put in another $1 million because you didn't figure out your net working capital correctly. So this is a huge, huge, huge component. And there's some metrics here that are absolutely important. DSO, DPO, and DOH. DSO is days sales outstanding. DPO is, DSO, day sales outstanding. That's how quickly the firm is collecting the money that is owed to them, how quickly they're turning accounts receivable into cash. DPO, just the opposite. It's how quickly they're paying their vendors or how quickly they're turning accounts payable into cash, debt cash outs, because you want to make sure, although you want to stretch out, your vendors as much as possible, you also don't want to make them angry. You want to keep your vendors happy because happy vendors are going to be happy suppliers for you as well. And then days on hand, that's an inventory metric. It really talks about how much inventory outstanding you have. So there's some big important metrics there to figure out your net working capital peg or how much money is needed in order to continue operating the business. These three will also give you what's called the cash conversion cycle. That's how quickly it takes you from sending money out to getting it back. How quickly you're paying from AP to getting money back, AP and inventory to getting your money back. You want that number as low as possible. There have been some times where we've looked at companies and we see this as a negative number. Love that. That means your vendors are funding your business because you're taking so long to pay them and you're collecting money in so easily. As long as your vendors are happy again, then hey, you know what? That's a great cash flowing business. So net working capital analysis. There again, there's some graphs that kind of illustrate those things a bit more as well. And then there's search for unrecorded liabilities. If anybody here has done auditing or knows anything about auditing, this is an auditing trick to basically test and see if they're GAAP compliant. Another conversation for another day. Don't worry about that too much today. And then here we go. There's our scope. And then supporting schedules. There's, kind of some of the raw data, or not raw data, but this is the monthly. You'll see where we've got TTM January, then we've got FY22, FY21 by month, back, and then there's, kind of some graphs and things. So let me stop sharing my screen. I know there's a bunch of questions in here. Let me jump into those. Hold on a second. Let me get that pulled up. All right, here we go. One VE side of using multiple instead of price, the broker deal cost for the buyer will be much higher. Generally, sellers have a number in mind when they put the business for sale. Yeah, definitely. And if the price comes out much less during the QofE, they may decide to not sell it for now. So, yeah, great point, sir. Yeah, thank you. Very good point. Jacob, if a private equity firm hires a quality of earnings firm, how involved is the private equity firm in this analysis? Great question. Are they working with you and management to develop this, or do they only get involved when the QofE is done and the QofE firm is presenting the report to the PE firm? What sort of things are PE firms most interested in when reading one of these reports? Are there certain sections of the report where they ask the most questions? I love this. Jacob, we got to connect after because it sounds like you have some solid questions. I definitely want to make sure I answer them all. So if the private equity firm, let me start off by saying this. The private equity firm, if they hire us, then how involved are they? They recognize, and absolutely fully admit that we are a third-party firm. We are not beholding to try to hit their number. And we make sure that we understand that. I'm coming in completely, absolutely unbiased. Now, let me caveat that for a second. We're always biased. Everybody's biased. I don't care who you are. I don't care what you're looking at or what you're buying. You have at least an inkling of biases. So if my firm that's paying me is a private equity firm, although I'm going to be as unbiased as possible, in my heart somewhere, I'm going to have some biases towards them a little bit. Same thing on the sell side. If the seller's the one that's hiring me, I'm going to be biased towards them. I'm going to try my best not to be, but as much as I admit I'm not, there's going to be a deep down part inside where I'm going to do my best to try to push that EBITDA as much as possible while still being completely unbiased about it, if that makes sense. So are they, the private equity firm, back to your question, Jacob, are they working with me and management to develop this, or do they get involved when the QofE? No. So there may be some questions back and forth. So let's say, for example, the private equity firm, and I'm going to use compensation, for example. Let's say the target, the management of the target represents that hey, you know what? We've been paying ourselves a salary of 250,000. We've been paying one guy, the founder, a salary of $250,000. But that's really too much for the market. You really should only pay him 100,000. I'm going to go back to the private equity firm and say, hey guys, what are your thoughts on that? They're paying him 250. They're saying you only need to pay 100, and so there's 150 in there. That difference that's in the management proposed earnings. I'm thinking the market's probably close to around 150, 175. What do you guys think? I mean, there's some back and forth questions and figuring out, and really, ultimately, it's going to be my decision what I put into quality of earnings. But I definitely want to make sure that I'm working between both sides, to understand why are they proposing this and why are they proposing this and what really should it be. Let's see, what sort of things are private equity firms most interested in when reading one of these reports? EBITDA. Private equity firms, they're buying it because it wants to increase their portfolio, increase EBITDA. That's going to be the number one thing they're looking at. While they're also looking at things like net working capital. Those are probably the two biggest things they're going to look at, as well as, and I would say the third one's going to be the concentrations and the trends, because they really want to understand where this firm has been and where are they going. And hopefully that's an upward trend. If it's not, probably not the best time to buy or sell. So, Jacob, I hope that answers your question. If not, please definitely reach out to me. Let's set up some time. I'd love to answer some more of your questions. We might have a few minutes here in the end in a second as well. Let's see, Nikhil, I observed that in a proof of cash, you have not adjusted sales tax liabilities. Shouldn't it be adjusted, or have we got the full money as revenue and have deposited in bank while created the liability for the same? Great question. It really depends upon how the firm has reported their sales tax liabilities. So I've seen it done in multiple ways. We will just look at what's going on with how they're reporting it, how it hits cash, how it hits balance sheet. Sometimes if they're hitting income statement, we'll look at that and then make sure to adjust accordingly on that. So thank you. All right, let's see. Jacob, what sort of things are PE firm most interested in when analyzing net working capital? Are there certain line items that really dig into in questions? I think it really just depends from what I've seen, depends upon what they are buying the company for. Net working capital, more than anything, they're looking at DSO, DPO, and DOH at those metrics, and how are those benchmarked against the industry? Let's see. Where am I? Here we go. Nora, some reports I came across had the balance sheet reorganized into net working cap, net debt, etc. Is that a norm? What do you essentially want to look for the way of presenting the balance sheet accounts? Nora, love this question. Thank you. I'm going to start off by saying this. A firm that is $100,000 in revenue is very different than a firm that's $1 million in revenue. It's very different than a firm that's 10 million and 100 million. I've looked at and done diligence on all of them. And the answer is, guess what? It depends. A normalized, we've looked at, so there again, we've been around for 30 years. We've looked at so many balance sheets and so many industries. We kind of know and understand what the industry standards are, for the particular size. And that's how we'll readjust that balance sheet based on that. We'll restate the balance sheet. It's not going to change the total numbers, but it'll kind of change those buckets. For example, I have seen many times, and I'm going to use this word very kindly because of ignorance, not stupidity, but ignorance. They didn't know. A lot of times, a PPP loan will be classified as a short-term liability when most of the times it's a long-term. Very simplistic example, short-term, 12 months or less, long-term, more than 12 months. And I see a lot of companies that'll classify short-term and long-term both interchangeably. We'll go in and readjust things based upon that. Net working capital, net debt, things like that. Yeah, all that just really, really depends. And that's why a quality of earnings is there again is stating adjusted financials to where you're looking at it from a normalized industry standpoint. So thank you for that question. let's see, with the owner compensation example, if he or she is paying themselves 300,000 and the market comp is only 200,000, does that mean there's going to be $100,000 add back to EBITDA? Yes. And vice versa. If the owner comp is 300, but a new person actually needs to be paid 200, is that a negative adjustment? Yes, Jacob, you've nailed it. Understand that. Perfect. Love it. Thank you. Regarding networking capital, it would be great if you held a conversational video into a deep dive on how the peg is determined. Oh man, now you're speaking my language. I love these conversations. And calculated and how this changes as the deal progresses, i.e., does a buyer or seller want a higher peg? What sort of items would a buyer want to include or strip out? It's always a fuzzy topic, in my opinion. Jacob, you are not alone, my friend. There are many of those negotiations. And you know what? I'm going to take you up on that. I will absolutely work on an Ask Me Anything focused strictly on networking capital. Actually, about a month ago, I was engaged by a business broker who's well known out here in Utah because he's like, Patrick, I just need help on my deals figuring out networking capital. So even for him, he's like, this is just it's a hard topic. So very, very good point. Felix, my friend, good to see you, brother. I saw you on the call earlier. Do you have any insights into the cost benefit analysis from a business owner perspective on delaying the sale of the business to focus on improving earnings to get a higher multiple at a later time, especially for sub $1 million revenue companies? You know what? I'll bet you are not the only one asking this question. Let me summarize and restate it. So Felix is asking, hey, what should I do? I have a sub $1 million revenue company that I would like to sell. Should I sell it today for whatever I've built it up to? Or should I continue building it for the next 3 years or whatever and sell it later at a higher multiple? The cost benefit analysis, I can help you work on that. I've helped many people on those. It's really going to be dependent upon you. Why are you selling the business? Are you selling it because you're tired and you don't want to do it anymore? Are you selling it because, hey, you know what? I've got another project I need to fund? Or are you selling it because you've had some inbound interest? It really depends. Uh, my default answer is if you can build it a little bit longer for a lot more money, do that. Don't take my word for it, though. This is your business and your decision. So it's ultimately going to be up to you. And I don't want to be the one, that you're coming back to and saying, oh my gosh, Patrick, you said I could build it for 3 more years. And in 3 years, I built it to a $10 million business, but now COVID hits and it's only worth a lot less. Not my fault. Hey, I tell you what I think. I gave you my opinion, based upon my experience and our firm's experience. Ultimately, you're the owner, you're the founder, you're the seller, you're the buyer. It's your decision. I love being a consultant because I can tell you exactly what I think and I can walk away and still have a job. So great question on that. Let's see. I'm going to nail through these last few real quick. Thank you for the video, answering all those questions. Absolutely, you're welcome. Is networking capital typically included as part of the price, or is that bought in addition to the sales price? Oh, yes, I love this question. I'm going to punt that because the short answer is yes and no. There's something called enterprise value, and there's something called purchase price, and there's a whole breakdown of that. That's going to be on the next Ask Me Anything, which I promise I will get set up hopefully here soon, maybe in the next month or so, because that is a solid, solid question, and I love it. Thank you. So I hope I got through all. Let's see. I believe the networking capital at close will adjust the purchase price. Exactly. You've nailed it. Yes. Thank you. Fantastic. Guys, oh my goodness. Thank you for joining. I'm just going to kind of jump on to this last slide real fast. That way you guys can see if there's any other, here we go. How do I get to this? Hold on a second. There we go. That way you can make sure, reach out to me. I assume you already know how because you've joined this call. I love this. I'm going to do my best. I'm not going to promise, but I'm going to do my best to share this recording as well as the slides here with everyone. If nothing else, I might just post it as a comment, a link to it or something in LinkedIn. and Search Funder. I don't know which way you guys were able to join, but hopefully this has been very beneficial. So great. Good to see everybody. Hopefully you'll have a great day. Please, please, please reach out to me. Any follow-ups, any questions, happy to be here and answer. Okay.